Hi and welcome to eLagaan Whiteboard Friday. Today we will look at something called liquidation preference. So what exactly is a liquidation preference? So this is a clause which is generally available on your shareholders agreement and whenever you are raising money. This helps investors to protect any downsizing or unexpected exit of the company in the scenario of things like, say, a merger or acquisition, or if the company is not doing great and if they're closing down or selling all their assets, kind of thing. So let's look at what are those factors that could really impact when a liquidation event happens. So the first and foremost thing is the multiplier. Now, a multiplier generally in a liquidation preference clause, you would see something called a 1x or a 1.5x, 1.25, 2x kind of thing. So basically, suppose an investor has put in about $1 million, and if you have agreed for say 1.5x multiplier, then the investor would get the first $1.5 million to their account before anybody else get anything. So suppose if you have sold the company for say $1 million, and if the liquidation preference was 1.5x, so then the whole $1 million will go just to the investor, nobody else gets anything. Same thing if you sell it for say $5 million, then again they get $1.5 million, and the balance $3.5 million is divided among the other equity shareholders of the company. So that is a multiplier. The second is a multiplier plus equity. So basically, if you see, like, investors do hold preference shares in most of the scenarios, or even it could have been converted to an equity shareholding. So if there is a multiplier like 1.5x, then 1.5 million goes to the investor. And suppose if they hold say 25% of the company, then out of the same $3.5 million which is remaining, 25% would of that amount would go to the investor. Now, if they hold preference shares, then that would go first to the investor. If they are equity, then yes, it gets distributed among the other guys. So that's another point that you could that is prevalent. On the multiplier side, you can say like 1 to 3x is generally that prevails into the industry. The most common one being between 1 to 2x. But the lower the multiplier is, the better for the company and the founders. The third thing is multiplier or equity. So first was like multiplier plus equity. The third point could be multiplier or equity depending on the option of investors. So as we discussed, like whenever there is a liquidity event that happens, so basically investor will have an option to either convert their holding into an equity shareholder and then take the money. So this generally is used whenever, like, if you do a mathematics. So for example, say you sold the company for $5 million, and the investor holds say 25% of the company. So basically they get about $1.25 million. Now if you have given them 1.5x valuation multiplier, then they are getting $1.5 million. So basically the multiplier makes more sense to them. So this gives investor the power to see which option is more favorable for them, and based on that they can take steps before the money is distributed. The fourth thing that I wanted to highlight is the preference of payouts. So basically, like, if you have raised multiple rounds of investment, so the latest round guys gets the money first before. So for example, if you have raised up to Series C, then whatever money is being distributed, the first Series C investors will get money, then Series B, then Series A, then angels or seed guys, and then the founders. So that is generally the sequence that is followed. This is generally prevent, so this kind of a preferential or preference of payout is generally covered in very advanced term sheets when company has really grown big. At an early stage, generally you don't see such clauses, but that is another clause that could be impacting how who gets how much and in what sequence that they get. So as I mentioned, like during many times you feel no, my company is just gonna do great, but you never know. Like right now we are all going through COVID times, and this has brought in a lot of fundamental changes in the way the companies are doing businesses. So you never know what lies ahead or tomorrow. So it is important that a liquidation preference should be dealt with and negotiated well. Otherwise, it could lead to like absolute nothing, no returns for the founders and stuff. So I think that's it on liquidation preference today. If you have any queries, feel free to reach out to us at hello@eLagaan.com. Thank you.